What's going on, guys? In this video, we're going to be doing a little bit of talking about one of the, I personally think, the number one trading mistake that most options players, do get into. So whether you are looking to, kind of buy and sell just, naked calls and puts, or you're looking to sell covered, there's a big, misconception when it comes to, how to really trade options. A lot of people are looking to kind of scalp and day trade options, which is very, very tricky. But I do teach that in my Discord. If you guys do want to learn, go ahead and join that Discord. But with that kind of being said, that's going to take a lot of technical analysis skills. You're going to need to learn how to analyze a chart very, very quickly. You're going to need to understand when to trade versus when not to trade, as well as which particular stocks according to your account size should you be trading. But let's just get into some of the things that I wrote down here for everyone today. So number one option trading mistake is buying out of the money call options. So how many times have you got into a trade, the trade has started to move up? Let's say, for example, we're buying some calls. That trade has started to move in your favor and then quickly kind of stalls out a little bit. Might be up, the stock price might be up just a little bit, and then as it starts to go into some consolidation, starts to drop, and then all of a sudden you just kind of see that premium get wiped away, and then what seems like you should be making money, or if breaking even, you're actually down, losing money. That's because you're buying out of the money call options. So for all of you day traders and scalpers, if you're looking to buy weekly contracts, I'm definitely going to recommend you to at least play at the money, in the money, never out of the money. If you are looking to get in and out of a trade today, I would definitely not be buying out of the money call options. If you cannot afford options, just do based on the premium is a little bit too expensive for your account, then kind of look for another stock that you can trade that maybe options you can afford. So let's go ahead and continue here. Purchasing out of the money call option seems like a good idea to start for new traders. Because they are low cost, buy a cheap call option and see if you can pick a winner. This may feel safe because it matches the pattern you're used to following as an equity trader. So what that kind of means is that if you guys have ever had any experience, kind of where you're buying and selling a particular stock, and I'll just use Apple for example. Let's say you buy 10 shares of Apple, and it goes up $1 over the course of 3 days. You're essentially going to make $1 per share, and if you own 10 shares, you just made $10. Options premiums are not going to work that way. There's something called implied volatility. There's also a lot of decay that is going to go involved and be tied into these options, so it's not going to move one to one. So that's why if you are looking to day trade and or scalp, going out of the money is never going to be your best bet. But let's just kind of get back to where we're at here. If you're used to following that kind of strategy as an equity trader, buy low and sell high. But they are one of the hardest ways to make money, by buying out of the money call options. Now, I know that we've all kind of bought that, out of the money call option. Market just seems to run. You really didn't have to do anything, and you made like a crap ton of money doing that. The only problem with that is that if you get comfortable doing that day in and day out, you are going to lose money more than you're going to make money. It's really not a way where you can be a consistent day trader if that's something you're looking to do. If you limit yourself to only this strategy, you may lose more money often than not. And then also, here's another thing that you guys can kind of dabble your hands into when it comes to options. You don't just have to buy calls or buy puts. What you can do is consider selling an out of the money call option on a stock that you already own. For example, let's say that I own 100 shares of Apple. I can go ahead and secure that by writing a covered call, meaning that you are going to collect that premium when someone buys that call option. And then depending on what the stock price does, you might get assigned. But okay, as long as I've been in this trading game, more often than not, you will not be assigned on the expiration date. So let's just continue here. One thing that's nice about covered calls as a strategy is the risk does not come from selling the option when the option is covered by a stock position. It also has potential to earn you income on stocks when you're bullish, but are willing to sell your stock if the stock price rises. Okay, this strategy can provide you with the feel for how to play an out of the money options contract. Let's say, for example, your average price on something like Apple is $100, and maybe you want to sell an out of the money call at, let's say, 105. You're going to go ahead and collect that premium. But however, if that stock price does rise to 105 and someone does choose to exercise that option, you will be assigned to go ahead and let go of those shares that you're putting up as collateral. Out of the money options contract prices change as expiration approaches and the stock price fluctuates. Also keep that in mind. The risk, however, is in owning the stock, and that risk can be substantial. Although selling the call option does not produce capital risk, it does limit your upside, therefore creating an opportunity risk. You risk having to sell the stock upon assignment if the market rises and your call is exercised. Let's say, for example, your average price is, let's say, $100 on your 100 shares of Apple. And let's say, for example, you're selling an out of the money call option at 105. And let's say something crazy happens in the market within the matter of a couple days time, the stock price goes to 125. Would you have made more money holding your 100 shares and making that $25 a share, or would you have made more money collecting that premium on that 105 options contract? Now, obviously, the answer is, having your 100 shares and making $25 a share, you're going to make a lot more money. So that's kind of one thing that you do have to kind of consider. However, if you do have a lot of shares in one particular stock and you're looking for kind of like a passive way to kind of dabble your feet in the option side of the game, rather than just going straight into the naked calls and naked puts, then maybe that might be something you want to explore. However, just keep in mind some of the cons that are going to come along with some of the pros. Guys, I'm going to do a lot more little, tutorial videos like this. I've written down a lot of things, come across a lot of things that I kind of want to share with you guys, some tips, tricks, and just general information on day trading, stocks, and the overall market. With that being said, make sure to like, comment, and subscribe on this video. Also, join that Discord if you guys are really serious about learning how to day trade and scalp options, especially. Same thing with equities. We have a lot of equity traders in the room as well. But if you're looking to specialize in options, that's something that I do full time and could most definitely help you out with. I have a lot of great information and training videos in there as well. And until next time, I'll see you guys on the next video.